So today I wanted to give some examples of market manipulation. I have a couple of other videos related to this topic, and you can check those out if you follow these links here. All right, bear raise. This is an example where some investors get together, they collude. That's a key component. They short shares of a stock, and then they launch a smear campaign with the intention of getting current holders of that stock to sell their shares and drive prices lower, at which time they can buy back their shares at a profit. Now, two key components here are that they are colluding together and that they are using false information to drive the prices lower. It is not illegal for a large group of investors to independently short a stock. It is not illegal for investors to express why they think a stock is overvalued if these reasons are true and legitimate. Churning is another example. The idea here is there's lots of excessive trading. Now, there is an example where it's like your broker, it's your account, and they're doing a bunch of trades in order to ramp up the fees for their benefit and your detriment. This is not an example of market manipulation, so we're going to go ahead and cross it off. The idea here, though, when it is market manipulation, is somebody buys and sells a bunch of the same stock at very close prices, so they're not really gaining or losing from it, to drive up the volume, then causing other investors to be excited about this volume and get into that stock, in which case, kind of moves the price in their favor. Cornering the market is an example where someone is buying a bunch of whatever that is, the stock, the bond, the commodity, in order to kind of take a huge portion of the supply. There are some kind of famous examples here. The Hunt brothers in the late 70s and early 80s tried to corner the silver market. At one point, they were like targeted for over half of the available silver out there. Another example, this Japanese trader Hamanaka tried to corner the copper market, and that ended up costing his company $2.6 billion. He ended up spending 8 years in jail. The interesting thing here, of course, is that this usually doesn't work. This cornering the market thing usually does not work. And even if you end up losing a ton of money on it, you can still spend time in jail because it's illegal regardless of its success rate. Cross-market manipulation. That's the idea here is there are related markets. So in this example, there are a number of things that are inputs for generating electricity. So there are markets for that input, and there are also power markets. So how much you can get from power. The idea here is you're gonna say jack up the price of natural gas in order to jack up the price of power and make your profit in that other market. Cross-product manipulation. The idea here is you have some financial instrument, usually a derivative product, that is tied to some benchmark, and that the price of that financial instrument, especially at settlement, is actually tied to that benchmark and not the supply and demand of that instrument. So the idea here is you're going to manipulate the prices of the benchmark in order to, to have favorable results on your financial instrument. Finally, for today, high closing. So the idea here is that you're going to manipulate the market right at the end of the day in order to get the close to be pretty high. Now, I know this happens in the indexing world because if a name gets added to an index, you're judged based on that closing price. So if you could enter into a portion of that position prior to the close and then drive that closing price up, then your kind of all-in price is going to be better than what you're judged against. So I know this happens. One way to kind of give yourself a sense of whether or not this is happening is to look at these candlestick charts. So here, we have high, close, open, low. If you look at that little chart there, the two kind of wicks at the end to kind of give you the difference between the close and the high and the open and the low. That could be flipped around, obviously, depending on, if it opens, or if the open is higher than the close is higher than the open. Anyway, one way to kind of get a sense of whether or not someone is high closing is when you see that close and the high at the same level. So you're actually not going to see that upper wick. Just one way to kind of give you a sense of that. Hopefully that makes sense. You can pause this if you need to. That's it for today. There are quite a few more examples, and I don't want these videos to be too long. I will follow up with more examples. Thanks so much for listening. I am Brian Kozlowski.